Texas Instruments, ticker TXN, is a company that has interested me for a very long time, but I so far haven't yet found a time to buy it at a discounted price. But with them falling by 8.5% over the past month, an opportunity might have opened up. And so that's exactly what we will do in this video. We will figure out if Texas Instruments is a buy at its current trading price. Now, the first thing that really frustrates me about Texas Instruments is their extremely high, above 100% trailing free cash flow payout ratio, which means that they are taking on debt to pay out their dividends. And so a huge big red flag for me. Now, if we jump to the 9-pillar analysis, we can see that the company gets a rating of 6 out of 9. And let's straight away jump to the free cash flow growth, which over the past 5 years has been decreasing at a rate of 18.46%. But if we jump closer, we can see that the huge decrease happened from 2022 to 2023 when the free cash flow declined to only $1.3 billion. And that's actually the similar case with the net income, which dropped from 2022 to 2023 and year over year dropped by another 23.73%, and the same case with the revenue, which also dropped over the past 2 years. So the low free cash flow is one of the reasons why the trailing free cash flow payout ratio is so high. But even if the free cash flow didn't drop, the free cash flow payout ratio would still be sitting above 80%, which is still a big red flag. Now we can also see that the company's stock price has been increasing by a lot over the past 2 years, despite the fact that their profits have been decreasing. And what this does is that it inflates the company's PE and price to free cash flow ratios. We can see that over the past 5 years, the PE ratio was sitting at 21.30, which is in the range we like to see. But if we jump closer, we can see that currently it is sitting at 35, which means that investors are overpaying for the company's earnings. And that wouldn't be happening if the price of the company wasn't artificially inflated and would grow alongside with the earnings. And as I said, this is the same case with the price to free cash flow, which is currently sitting at 128.32. So we can see that the company is extremely overvalued compared to their free cash flow and overvalued compared to their net income as well. Now, one thing I do like about the company is that they are very profitable. They have a profit margin of 65.39%. Now, again, let me raise my concern about the dividends of the company. We can see that the consecutive dividend growth has been on average sitting at 10.22% yearly. But if we jump closer, we can see that the growth has been declining over the past few years. And that is because the free cash flow wasn't plentiful while the shares were increasing. And so I do believe that there will be a dividend cut soon, and this is also supported by the final pillar, the long-term liabilities over the 5-year free cash flow negative dividends, which is sitting at 15, which means that the company would take about 75 years to pay off all their long-term liabilities while paying out their current dividend with the free cash flow they currently generate. While if they didn't pay out any dividends, it would take them only about 3 to 4 years to pay off all their long-term liabilities because they don't really have much of them. They only have about 14 billion, which is nothing compared to their market cap. So overall, the company isn't looking too great. But now let's calculate its intrinsic value. So first, using the Graham's formula revised, we plug in earnings growth estimate at 17.67% yearly and get an intrinsic value of $221.23. For the second valuation model, we take the free cash flow of the company, plug in a growth rate at 10%, discount rate at 8.9%, and get an intrinsic value of $181. For the third valuation model, we want to compare Texas Instruments to its competitors, and we get an intrinsic value of $138.25. And finally, looking at the dividend discount model, as I said, I do believe that there will be a dividend cut, so I will project a growth rate of only 4%, and by doing this, we get an intrinsic value of $107.56. And finally, averaging out those four valuation models, we get an intrinsic value of $162.01, which is 14% lower than the current trading price. And so overall, my opinion is that Texas Instruments share price was inflated by the huge growth in the tech sector, and that due to that they are trading above their intrinsic value. And with that, I hope that you enjoyed the video. Make sure to leave a like and subscribe as it really helps me out.